Okay. Great. So you should see our disclosures there. If you can just take a read of that. I'm just going to pull up a few charts and we'll get started really soon. Thanks everyone for joining. It's good to see so many of you here. Good morning to you, Ray. I know you've been here for a long time. So thank you, everybody. I know it's half term as well. So a lot of parents are away, so they're not involved. But those of you who are here, there's still lots going on. And it's going to be an interesting week. It's already been interesting. So I'll talk about that and then we can go through a few other bits as well. So just looking at our disclosures, this presentation is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. This presentation or webinar has been prepared without regard to the specific investment objectives, financial situation, and needs of any particular recipient, and we don't guarantee or verify the accuracy or information or commentary provided. Futures, options on futures, foreign exchange, and other leverage products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts are not subject to regulation under the U.S. Commodities Exchange Act. And contracts of difference, otherwise known as CFDs, they're not available for U.S. residents due to regulatory reasons. Okay, guys, thank you so much for joining. Let's put that away and do a quick swift swap. Here we go. Push that down and let's get right into it today. There you go. You can see my nice screensaver there. Very spring-like, even though it may not feel like spring yet. It's a little bit early. But this is pound. Very, very basic pound chart here, just cable. As you can see, it's a daily chart. I'm going to put it down to the hourly because obviously we've had a big sell-off, right? So we got to a high of 168.25 and then we pulled back very, very sharply at times yesterday. And then today, again, we've had these, the last kind of, how long is it? An hour and a half, really, yes, about two of these big bars here. They're reflecting the sell-off in the pound that was triggered by some weaker than expected UK inflation data. So that came in at 1.9%. For those of you from the UK, you'll know, Alan, bear with me 1 minute. I'm just going to talk about cable to start with. For those of you who are from the UK, you'll know that inflation's been so strong for so long that for us to fall below the target rate, and remember 2% is government's target, not actually the Bank of England's target. It's set by the government. This is a big deal, right? So it really eases the pressure of the Bank of England to tighten rates anytime soon. Hence why we've seen the pound fall. Also, interest rate expectations out of the UK using forward curve analysis. I took a look at that earlier this morning. That's in my latest research piece, which I will post to you now. That interest rates have been pushed further into 2015, basically. Hence why we've seen that's the sell-off. From a technical perspective, though, that sell-off has really it's been cushioned. The blow has been cushioned, I should say. This 66.50 level, was kind of a sticky level on the 13th, so last Thursday. Funnily enough, we stayed above there today. That's a positive sign. It was also, just to draw your attention to the hourly MACD on the short-term surveys, it was also looking very oversold in the short term, so hence why we pulled back. And I want to, in fact, I'm going to take this fib retracement off, but I just really wanted to show you that even if we do pull back, we're still in a very good position, right? We're still in an uptrend. In fact, I'm going to bring over my Bloomberg chart just because that's just a little bit easier for me to just navigate through. Just bear with me. As you can see here, we could probably fall back to this 50-day moving average at 164.50 and still be in that uptrend. As long as we don't fall kind of that coincides. The 164.50 level is the pink line on this chart. It's the 50-day moving average. It also coincides with these lows from the 27th of Jan, or just there around about that level. As long as we don't fall below there, we can have a deeper pullback. In fact, if anything, a pullback is natural at this time. Look at this, these trending from Wednesday last week when we got that less dovish than expected inflation report from the Bank of England, we really just surged higher, and you really see that in the pound. I mean, if I bring us back to 5 years, we're so guilty in the pound. You rush higher and then you come off. You rush higher and then you come off. It doesn't have a nice, seamless rhythm. cable doesn't. It is actually one of the at the riskier end of the majors out of the G10. So we go all the way up to 168, kind of almost on a whim, on early on Monday morning, and then we pull back. That's very normal cable behavior, and it does not mean that the uptrend is over. We still think that for now anyway, the fundamentals and the technicals are in place to see us to continue to be in this uptrend. However, we would expect a pullback, and as I said, we think there is a chance of a deeper pullback than what we've seen already. Pan, you said what's oversold in a strong economy. I'm not 100% sure I understand your question, Pan. If you just want to, I think that's a statement. Oh, no, it's a question. If you just want to elaborate a little bit more, and then I'll get back to you. But I was just saying that pound, when I mentioned oversold, I said that the pound looked oversold on the hourly chart. I'll just bring up my RSI as well just to show you that. As you can see, we dipped below the 30 mark in the hourly chart, this is the hourly RSI, which is reflective of this move lower here. We just suggested that the market got a little bit ahead of itself selling cable. Yes, fair enough. There has been this drop in inflation sub 2%. But remember, we have other event risks coming up for the UK this week. We have Bank of England minutes tomorrow. We have labour market data out of the UK tomorrow as well. And then on Friday, we have retail sales. So labour market data, if that's strong, then I think the market will probably may even look through some of the inflation data. Why could the cable not keep going up? I find it very confusing near tops. Yes, I think what you're saying is that we are talking on the same line here. Cable can keep going, right? Of course it can. The economy is still strong, and it doesn't look like the Bank of England look out of all the G10 central banks. They're on kind of probably them and the RBNZ now look like they're most likely to hike rates first. However, that doesn't, even though that's kind of the long-term path, maybe, that doesn't mean that there aren't stumbling blocks on that road. And one of the stumbling blocks, obviously, is that if you get weaker inflation like we saw today out of the UK, it does ease pressure to hike interest rates, and the interest rates have a big impact on the pound. Hence why when there's reduced interest rate expectations of increases in interest rates, that's why we see the pound just pull back a little bit. So as I said, we still, let me just pull up that, this one here, that's a lovely uptrend, right? The uptrend is still in place from July. In fact, if anything, it's gathered some intensity since earlier this month. We could still push higher, but what I said was we just went too far. So, no trend moves in a straight line, Pan. That's kind of the key thing. But I agree with you. At the moment, the dollar is still unloved. So why wouldn't the pound push higher? And it may take something like, the dollar to really come back with a vengeance before we can move higher. And right now, what we know is that the market is being very unforgiving of the US economy. That's been the economic data has been really hit hard by the weather effect in the US, and that's really just triggered a weaker dollar. And again, that certainly benefited things like the pound. And Pan, you're saying, difficult to go short. I think, from a fundamental perspective, it is. From a technical perspective, people possibly, the opportunity may be to fade any dips that we see, and actually a pullback at these highs. We've got to the highest level since 2009. That's very normal for people to take profit when you get a big push higher like we did last week. So yes, the trend could continue. One thing I would argue, though, with the pound is that we don't think we'll see the same pace of gains that we saw last week. Very, very strong gains last week. It was up over 2%. That doesn't last, but it doesn't mean that you don't drift higher as well. Okay, Alan, you've waited very patiently for the Kiwi. Obviously, the New Zealand dollar in the next few weeks is going to really come into its own. We wait for that all-important RBNZ meeting, which will take place in March. The market will be is potentially looking for a rate hike. Let me just move back up to your question. Bear with me, Alan, and all of you, and I will answer it. Alan, you mentioned that weakness recently since the cut break to 83.80 level. My opinion, yes. I mean, that is a key level on the upside. The Kiwi dollar is considered a kind of a risky, at the risky end of the FX market. And what we've seen is just a complete reversal here. Partly what's going on with the Kiwi is also today anyway, or in the last 2 days, is also a reflection of dollar yen. Let me just bring that up. So it's actually got nothing to do with the Kiwi, because we haven't really seen anything in the New Zealand, out in the New Zealand economy. But what we do know is that, in the last, we do know that obviously what we've seen here, if I just do this, hopefully this isn't too confusing. This is New Zealand US dollar. This is the kind. So this is New Zealand US dollar. This is Kiwi yen. And what we've seen, Kiwi yen has really stalled as the yen, Kiwi yen kind of stalled a little bit. We haven't really extended the upside there. And that's having a bit of an impact on the New Zealand broadly. I also just want to show you the dollar yen, because this goes some way to show why the Kiwi dollar is coming off today. Dollar yen, as you can see, it pushed higher earlier today, and that's had an overall positive impact on the dollar. And I can show you that by looking at the dollar index. Dollar index, as you can see, it's not looking fantastic, but it certainly has base. So this 83.80 level, when you get a period of kind of dollar strength combined with, maybe some nervousness, when you see, when you get kind of a period of, there's no real reason really to get us above 84 is what I'm trying to say. Recent data has been flat. Alan, from New Zealand, are you talking about? I think it could be, there was some notable, data misses actually. And I'm just pulling up my calendar. Just bear with me 1 minute, because I just want to tell you, I still believe when it comes to the, when it comes to the New Zealand dollar, it's that RBNZ meeting, which is really going to be absolutely, let me get rid of that, is going to be absolutely critical. What we saw over the last week is that the data in New Zealand has been all right. Retail sales, which came out on the 16th, so late on Sunday, were slightly disappointing, I suppose, not as strong as expected. But then we had, by and large, the economy there looks fine. But it's really going to be that RBNZ meeting is going to be absolutely critical in our view. Just finding the time of it, or the date of it, for you guys. It's the 12th of March, and the market is pricing in right now for a rate hike to 2.75%. I think the symbolism of that will have an impact, but really until then, obviously the weaker the data gets, the more unlikely it is that the data misses, the more unlikely it is that the RBNZ actually pulls the trigger. So, we have seen that reversal in Kiwi, and it's been triggered by two things. One, some renewed dollar strength overnight, even though we don't think that will necessarily last. And the second thing is just, those weak retail sales have really weighed on the Kiwi. And from a technical perspective, that 83.80 to 84 level is a massive level of resistance. You're going all the way back to October really to get higher levels from there. And there just doesn't seem to be. We're in too much of an uncertain environment. It would be disingenuous to say that the Kiwi isn't also being weighed down by what's going on in the Aussie. Obviously, the Aussie has been just a little bit erratic the last few days, and that's also weighed on there. But as you can see, I would expect us, Alan, to really trade in a range. There is a good cushion or a cluster there of moving average supports. The 50 and the 100 day, they come in at 82.56 to 82.76. That should really act as the downside. So about 50 pips from where we are now, we're currently trading around about 83.20. So I think that we're still in range trading mode, and I'm not seeing there's nothing at the moment to me to suggest a clear reason why we would break out the top of that range. And what we do know is that 84 is going to take one hell of a bust to get above there, because the market has just rejected it, 4 times now. So if anything, that suggests that the bias could potentially be to the downside. But as I said, from a fundamental perspective, you've got to watch the RBNZ, because if they hike interest rates, I think from symbolic, that will be very, very symbolic and could boost, certainly protect the downside in Kiwi anyway. I'm going to look at the Aussie now. Alan and Pan are looking at Aussie, and I think that makes sense. As you can see with the Aussie, well, you can't at the moment, bear with us. We're hovering around that 90 level. 90.5 has really kind of triggered a little bit of profit taking, a little bit of soul searching. As you can see, we had a nice push higher on the back of, at the beginning of this month, that's on the back of the RBA dropping its neutral, dropping its dovish bias, moving to a neutral bias. The markets are very sensitive to changes in monetary policy, even if it's not actual changes and just kind of rhetorical changes. They are sensitive to that, but we just couldn't extend on the upside. So those people who rode this wave all the way down from kind of 86.50 to 90, they had a nice move higher. Yes, there could potentially be a double top, Alan, on the hourly chart, and I will look at that in a moment for the Aussie, because we're just not really a technical perspective is weighing on us here. We had the RBA minutes overnight. If I just go to an hourly, because we did get to a minute chart, hang on. As you can see, this was the RBA minute, pushed all the way back to 90.80, and then we just drifted lower. We also had the news out of China that China, the People's Bank of China had actually come in and withdrawn some liquidity from the market, which suggests that they've still got a mild tightening bias. That has knock-on negative effect on the Aussie. But overall, we just kind of moved sideways. 90 does seem to be protected on the downside there. I also just want to show you my other chart, just over for 1 minute. This is the hourly chart. Let me just push it together a little bit. Sorry, it's not looking fabulous. Too much. As you can see, a bit of a double top going on. We're not looking, it's not looking, this kind of 90.70 is just acting as very stiff resistance. We don't have too much going on now coming out of Australia. It's probably going to be dependent on what comes out of the US. Today and this week in the US, we do have some important data. We have the start of kind of the ISM or the PMI releases with the Empire Manufacturing later. We then get some housing market data this week. We also get PPI, CPI, and Fed minutes. So there's a packed data calendar, and that could, be that to us is going to be determined. It's going to be the chief determinant of things like the Aussie and the Kiwi, because there just aren't any domestic drivers. Obviously, it's worth watching out what China does, because when China kind of adjusts policy in any way or shape or form, as you can see here, the Aussie gets hit quite hard. So, we've seen the Aussie kind of fall off. But really, that 90 level, we were we were touching oversold territory in the daily RSI, in the hourly RSI, as well. So a pullback from here is completely normal. But as you can see, kind of from where we are now, near-term resistance around about that 90.40 to 90.50 level. So yeah, I agree with you there. Potential double top around about 90.80, and we couldn't get above there earlier either, which was quite negative. Pan, you're looking at the weekly chart as well. Yes, that 86.50 level, I think that 86.50 level, that I think you may have been mentioning, or you may have mentioned. Yes, that's certainly cushioning the downside. Nice reversal from there. The Aussie still looks weak. As you can see here, Aussie still looks weak. It had 3 good weeks. But unless we get above kind of these levels between 90.70 to 91.20, it's going to be very hard for us to get kind of on a prolonged uptrend. Right now, it just looks like a bit of a reversal, to be quite honest. Obviously, Aussie gold as well. It's from the commodity currencies. Let's have a look. Gold. Let's go back to a decent chart. As you can see, fell off those highs, those 1330 highs. Highest level there since November, since late October. We backed away from there. So we have been trading, we've dropped about $15. Still looks good though, as you can see, still in the uptrend in our view. Let me just take a quick look at my Bloomberg chart. We can just see a few other interesting things on here. I'm just going to look on the spot charts, guys, just to give you an overall sense. There's been a couple of things weighing on gold. Obviously, the slight uptick in the dollar today, with dollar yen pushing higher as well. Dollar yen pushing higher, that didn't help. But it's very hard to find individual drivers. Obviously, weak inflation pressure out of the UK doesn't help gold either. Gold tends to be an inflation hedge, and what we do know is that there's not that much inflation out there in the developed market economies. But it's very hard to pinpoint just one fundamental reason why gold pushed higher. In fact, if anything, it was probably to do with it just investors just booking profits, and there haven't been too many themes really since the start of this year. So a pullback is completely normal. Pan, were you thinking about one more push higher in Aussie? I believe you could have been. If you are, then I would say wait for a breakout. In gold, sorry. I wouldn't necessarily say that the uptrend of gold is over yet. I would just say that right now it looks very much like it's a technical move, right? This pullback's been a technical move, as you can see. Let me just draw that line. Potentially we could pull back, quite substantially. This isn't perfect, guys. I'm just doing this, you could probably even stretch that out. We could pull back even further, maybe even back to 12.90 and still move higher. And I think people will possibly try to buy it on the dip. Some people have been talking about gold in terms of kind of Chinese investor demand and other things, but propping it up is, potentially the market is also just reacting to the fact that gold tended to, gold led the market lower from here, really, from all the way back to 2012, before deflation became a problem, feeling that there was going to be weakening. Gold could basically be a bit of a lead indicator. That's not a perfect trend line by any means, so let's just get rid of that. One thing I would say is that this pullback from now, we were looking very overboard in gold at these levels, so a pullback is completely normal. Now we could find just a bit of bottom around about 13.10. So I wouldn't necessarily say, Pam, that we're going to be completely out of it. I would just say that you do have to just play it by ear. As we know with gold, it can be incredibly volatile, can be very, very choppy. Hasn't been able to sustain an uptrend right recently as well. So investors are going to get nervous when we get to these multi-month highs. Could 1178 be a double bottom, George? Yes, that was the low from December. It certainly looks like there is definitely some interest there to pick it up on the downside. Just go to this weekly. That was also the low, yes, from kind of June-ish, when we dipped quite sharply. One thing I would point out, though, just looking at the weekly chart, we've got since the start of this year, the weekly price ranges in gold have really narrowed quite sharply. If you look at the candles, for 2013, even some for 2012, particularly for 2013, actually, gold was in a much more volatile position. So it does seem like the market has just become a little bit steadier. And one thing we do know is that investors in China, I've mentioned, but also in India, even though there are some restrictions, capital restrictions on gold imports there, but we do know that they are, gold does get picked up on the dip. And it did need to move into kind of oversold territory here on the weekly chart, so long-term oversold territory before it kind of traded higher. But investors aren't willing to just rush it up, and I don't think it will be the easiest trend. Would be my argument from here. Someone looking for a quick buck, maybe it's one of the short-term things, maybe not as fast moving for the longer-term traders as one may like. But let me just send you a link to some of our research. Because we've got lots written on gold. My colleague Fawad here writes about it. This will also give you access to our latest, let me just put it here, access to our latest about the UK data that I mentioned to you, and also some of the Aussie stuff that was out overnight. So, Alan, that may be useful for you. Pan, you were talking about the pound as well, so that may be useful for you. So as you can see, this nice, gold, again, it's hard to know. Did gold come off today because the dollar was stronger? It could have been, but overall, on the long-term basis, that doesn't really tally up. Now, we also had some ZEW data out of the Eurozone today. I wanted to show you just a couple of things. We have kind of moved higher. We've ignored some pockets of weakness in that ZEW survey coming out of Germany. The forward-looking indicator wasn't nearly as strong as some had expected it to be. But why is this really important? Because I sent out a piece yesterday. You can see it on that feed if you just scroll down. Looking at the dollar, basically, its inability to rally. It's been really frustrating. The market is very much punishing, I think, the dollar, because it's just been such a failure. Those stronger dollar theme that a lot of people were talking about as we came into 2014 certainly hasn't lived up to expectations. And as you can see here, euro is punched back above the cloud there. That is a bullish development. The cloud base comes in at 135.95. That is now a key short-term support level. We managed to kind of close up there. We're not really extending gains dramatically, but we are testing a key level, 137.35 to 40. That is the level. If I just go back to my candle chart here, it's fib level. That's why a lot of people are looking at it. We need to get a daily close above this level. It's from the spike there to the lows in Feb. So we're just testing it now, and it is the 61.8% retracement of the deck to Feb sell-off, 137.35 say to 40. We need a daily close above there anyway, for us to even have another attempt at kind of the 138 and potentially even those 139 highs. Whether or not we get above there, though, as I said, could all be dependent on the US dollar. One thing we did see yesterday, which we haven't seen for a while, was that we haven't seen for a while was just a couple of people talk about, a couple of official members come out and talk about the strength of the euro, including the Dutch finance minister and the head of the Eurofin meetings, Jerome Dijsselbloem, out of Holland. He came out and said that, yes, the euro is looking strong, as some people would say it was too strong. Novotny as well, and we've had some other ECB members just come out and just talk about kind of negative deposit rates, not saying that they'll use them, just saying that they're all ready. Correa said that they could certainly loosen monetary policy further as well. So the risk is, as we lead up to the March ECB meeting, it's still a couple of weeks away, but as we lead up to that, we may see, what we know in the past is that Draghi, when he's wanted to talk down the euro, has done so very well and slammed it lower. So if he does the same, uses the same tactic, because we get maybe back to 138 or even 139, the closer we get to 138 and then to those 138.93 highs of the last 12 months, the more chance there is of some sort of intervention risk from the ECB, and that could lead to things getting a bit nervous up here. So it's not going to be every rally that we seem to see right now seems to be a bit torturous, with reversals coming here, there, and everywhere. But I know a lot of people have wanted to sell the euro and have just been totally frustrated. So a daily close above 137.40, I think, makes that very unlikely. As you can see, just looking at this chart using euro as an example, no prevailing trend in 2014 so far. Again, very, very frustrating. What do you do in that condition? Well, you put what your mind thinks, and what your gut thinks, what your mind thinks, and your wonderful fundamental argument of why the euro should fall. You put that to one side, and you go with kind of price action, because that's all that matters at the end of the day. We can all have feelings that come up with wonderful treatises why things have to move in a certain direction. It doesn't mean that they do. We have no control over that. So basically, I think a lot of people are looking at this 137.35 to 40 level. If we can manage to get above here, and we have tested it quite nicely today, then that could open the way to kind of 138.30 as well, ahead of that 138.95 level. Someone wanted to talk about Japan. What do I think Abe may do now? Not 100% sure, but the fact that Japan were willing to extend, they weren't willing to go the whole hog and do more QE. Remember, they also already buy between $50 and $80 billion worth of assets every single month. I mean, compared to the size of the economy, they're doing so much more QE compared to the US even. So, they are QE'd out. I don't think we should expect to see any more QE. There could be more stimulus, though, from the government, maybe, but basically, they are expected to go ahead with the sales tax rise in April. The GDP data was quite weak for Q4 because we didn't see any front loading of purchases ahead of this sales tax. Be interesting to see whether or not we see that in Q1 instead. What we tend to see, and this doesn't always happen, but there is kind of year end in Japan comes in the end of March, just ahead of that sales tax increase actually. That could lead to a little bit of yen weakness as people kind of, big Japanese companies are selling yen, and kind of, weakening the yen to boost their products, their profits. That's very difficult to measure, and I don't really buy that argument. Pan, you're saying sales tax should be yen strength. Well, I'm not saying that. What I'm saying is that sales tax will only, the sales tax, if it weighs on the economy and triggers more, largesse from the Bank of Japan or more stimulus from the government of Japan, that could trigger yen weakness. But if it doesn't, then it's going to be hard to see really the yen do anything one way or the other. Usually what you see in periods of economic turmoil in Japan is that actually causes the yen to rally. And that's what we saw yesterday, was a bit of yen strength on the back of the weaker GDP. But anyway, overnight, on the back of that Bank of Japan meeting, and that extension of the some loans for the government, for the economy, to try and boost the economy that way. We have seen yen sell off a little bit, which has helped dollar yen to recover. 101.47 on the downside. However, we're nowhere near any kind of positive levels. 103.10 we pointed out yesterday as being a key resistance. Here we go. 103.10. It's a 50% retracement of the January sell-off. And then above there, you're looking at 103.5 thereabouts, which is the 50-day moving average. I also want to just show you this, because this is quite significant. Whether or not we were going to get back to 100. A lot of people were talking about that. And as you can see, we've held onto the base of this cloud, which comes in at 101.50. So we did hold above that. That was kind of, the 100-day moving average that I mentioned to you there. That's also the base of the daily cloud. So we've managed to cap the downside for now. So that does reinstate that 101.50 level as a key level of support there in the short term. It looks like a short-term low to me. So right now, those of you trading dollar yen, it looks like we've put in a medium-term low, but it doesn't look like we're accelerating too much of the downside. We're trapped in this very tight range. Bank of Japan meeting couldn't take us out of there. The Fed minutes will be worth watching out for this week, and also some of that US economic data. This could be more of a dollar move. And obviously, if we see the dollar actually stage a meaningful recovery, then we could see, then we'd definitely see a dollar yen move higher, maybe potentially back to the top of that daily cloud, which comes in at 103.98. But I did mention some other levels there as well. Okay, guys. That's it for me. If you've got one question, let me know. If you've got any questions, let me know. Happy to do that. Dollar CAD. Okay, great. I'll do one last time. Dollar CAD, as you can see here, dollar CAD looks nice. It's trading a bit like an emerging market currency, the CAD. It's been trending lower. It looks well below 109.50. 108.67 is the downside there to watch out for. We've also got some fib support as well. But those people looking for the CAD to really kind of fall off a cliff, well, it hasn't. It's staged a nice recovery. 109.05 is a 50% retracement of the Jan to very early Feb move higher there, as you can see. So 109 should act as fairly good support, but a lot of it will depend on the dollar. With the dollar being unable to rally, things like the CAD, things like the Turkish lira, things like the South African rand, they've all been able to stage a recovery, and it's all because of the US's the dollar's inability to rally, we believe. And that's the same here. Even the rand's recovered. And we know that there's still many political problems and also economic problems in Turkey, for example, and in South Africa. But the market is just ditching the dollar. It still doesn't like it. Whether or not it can continue, it'll be interesting to see. Join me next week, guys, because it'll be really interesting to see how that moves higher and how that continues and how that continues to evolve. Whether or not the dollar can stage a meaningful rally at the moment still looks very, very weak. That's been the theme of today's discussion, I suppose. But thank you, everybody, for joining. Thanks for you're always so lively, and there's a full group of you. So thanks very much, and I look forward to you joining us next week. Bye.